Look, August was a month to fasten your seatbelts, but we still saw stocks ending higher. What's the setup for September?
Well, probably pretty similar setup. I do think it became clear in August the Fed is ready. Inflation has cooled off enough. We also see labor market as still relatively solid, but has cooled off enough to basically let the first interest rate cut happening. And it will be not an aggressive cutting cycle. That's not what we expect. We actually do expect a very gradual adjustment of the relatively tight monetary policy we have seen. So we do think 25 basis points September, and then probably in every single Fed meeting, there will be a 25 basis points cut. That brings us probably at the end somewhere around 350, 300 basis points of Fed fund rates at the end of this cycle. And it should be a fairly good environment for equities and bonds overall, as economy is still relatively solid. But of course, some valuations, some pockets are a bit more expensive. There will be sometimes fear around growth, and some data are probably disappointing, and that will spike this volatility as we have seen quite strong financial markets over the last 18 months.
So, Adrian, walk me through what to expect from here, because investors are laser focused on the data coming out of the United States and really questioning whether or not a 25 basis point cut is going to be a green light for markets or a sell signal. So what's your view on that? And ultimately, how do you want to be positioned as the rate unwind takes place?
Well, I still think this is a positive sign. Should not forget that in the past, so we went back basically the last 50 years, we looked at every new interest rate cutting cycle, and we differentiated if the economy ended up in a recession or not. We think it will not have been in a recession. And if you're not up in a recession, then actually markets tend to go up for the next 12 months after the first cut, because the Fed becomes slightly more stimulative and less hawkish. And that's happening in an environment where growth still can happen, where earnings can happen. So we're definitely in this camp at this point. I think one of the inflection points through this cut will be on the FX side. We actually do expect the US dollar to be the weak link now in the G10 currencies, as the Fed has to cut more than other central banks. It also starts a little bit later than other central banks, so interest rate differential will converge. That will weigh on the US dollar. That's opportunity. You mentioned that earlier. On gold as well, we actually do think gold is really set up for even higher levels at this point, and that's still an opportunity we actually do see. And then on the fixed income side, market has scaled back a little bit of profits. I mean, locked in some of the profits of a long duration. We still think that actually fixed income at the yields we're currently seeing are still very, very attractive. And you probably want to move out of cash, locking in some of the duration we actually still get, and be positioned basically for this cutting cycle.